Hello everyone. We completed up to margin lending in the directive series under directive number 2 in previous video, and now let's move towards further provisions, and this video is a complete video of directive number 2. This is the last one, and the provisions after margin lending are regarding the provision of loans by pledging founder shares of banks and financial institutions. Credit can be granted by pledging founder shares of the banks and financial institutions upon fulfilling the following conditions. The conditions are: necessary measures must be taken to control and manage the risks arising from providing credit by pledging founder shares. Similarly, shareholders from founder or founder groups who hold more than 1% founder shares in a licensed bank or financial institution cannot pledge more than 50% of their held founder shares to obtain credit. The bank or financial institution responsible for registering the pledged shares must ensure compliance with this provision. Founder shareholders holding 2% or more shares in any licensed institution can place their shares at another bank or sell them only with the approval of this bank. Next is, when requesting approval per subsection C, the institution in which the shares are to be placed must submit details of share ownership and whether the shares are already placed when seeking approval. For the purpose of lending against the collateral of founder shares, when evaluating the shares placed as security, the value should be determined based on either up to 50% of the average price of ordinary shares over the last 180 working days or the last transaction price of the founder shares, whichever is lower. A loan can be provided up to a maximum of 50% of this established value. Once such a loan has been disbursed, there will be no revaluation of the shares held as security to establish a new credit limit or for providing additional loans. However, if the market value decreases and the loan becomes unsecured, additional security arrangements must be made. Similarly, founder shares used as collateral for loan disbursement cannot be transferred to non-banking assets, and such placed founder shares must be sold under prevailing laws and these banks' directives within 6 months of the payment period being due. The payment period must be determined when founder shares are used as collateral for loan disbursement, and such a period shall not exceed 1 year. When loans are disbursed using founder shares as collateral, renewal, restructuring or rescheduling of the loan is not permitted. However, if a founder with a ownership of up to 0.5% of the founder shares is utilizing a loan with share pledged as collateral, and if the entire outstanding interest of the loan is paid and the loan is in regular status, then there is no obstacle for the renewal of such loan. When disbursing loans by placing founder shares as collateral, a 100% loan loss provision must be made in circumstances other than past loan. If the loan is not repaid within the stipulated period, the founder or director must be given a 35-day notice with reasons for inclusion in the blacklist, followed by a mandatory recommendation to the Credit Information Center to include them in the blacklist within 7 days. This provision must be maintained in the loan deed with the borrower at the time of loan disbursement. The arrangements specified above from A to E must be clearly stated in the credit policy or regulations of bank and financial institutions. 19. With regard to bank guarantee. In the event that payment needs to be made to the beneficiary based on bank guarantees issued by banks and financial institutions, the payment must be completed within 7 working days from the claim date. Additionally, in the case of bank guarantees issued under the International Chamber of Commerce and Uniform Rules for Demand Guarantee 758, URDG 758, Decisions regarding payment must be made subject to the provisions in the URDG. In the event that the institution issuing the bank guarantee fails to make the payment to the beneficiary without sufficient grounds within 7 working days of such a claim being made, the amount may be deducted from the account of the respective bank or financial institution held with this bank or ordered by this bank and be paid to the respective beneficiary. For the purpose of calculating the capital adequacy ratio, a risk weight of 200% must be assigned to the potential liability under the guarantee for which a claim for payment has been made. Number 20. Interbank transaction or borrowing or investment. The Class A, B, and C banks and financial institutions licensed from this bank shall use the borrowing or investment to be made to each other only as interbank transaction, borrowing, or investment, and not as the regular credit facility. The maximum term for interbank borrowing will be only up to 7 days. Number 21. Regarding the disbursement of loans only within the approved geographical areas. Apart from hire purchase loans, when providing loans secured by immovable property, such loans and the project or business must be within one's geographical area of operation. Until such loans outside the geographical area are not recovered, 100% loan loss provision must be maintained. Number 22. Trust receipt loan. The trust receipt loan, bills discounted, or other similar type of import loans shall be extended only up to a period of 90 days. Number 23. Prohibition on guaranteeing or granting loans against check or collateral or security. Licensed institutions are not allowed to grant loans against any form of check, collateral, or security. Additionally, this domestic check clearing can be done on the same day. Such checks cannot be purchased. Number 24. Regarding the prohibition on lending against foreign collateral or security, licensed institutions are not allowed to extend loans on collateral or security located abroad where rights cannot be established. Number 25. Regarding personal loans such as overdrafts and those with unspecified purposes. Banks and financial institutions are allowed to extend loans up to Nepalese rupees 5 million per customer for personal purpose under any heading including unspecified overdrafts, mortgage loans, property loans, personal term loans, and loans provided against share collateral. When disbursing such new loans or when adding to or renewing a loan against a property mortgage, the loan to value ratio at fair market value should be maintained at a maximum of 50%. However, this regulation will not be considered an obstacle for licensed institutions to provide loans against their own term deposit receipts, gold and silver, and the government of Nepal or Nepal Rashtra Bank bonds, or to issue guarantees with 100% cash margin. Various banks and financial institutions will be allowed to extend unsecured overdraft loans up to a maximum of Nepalese rupees 5 million per individual. The banks and financial institutions providing these loans must ensure that this limit is not exceeded at the time of lending. If the specified limit is exceeded or if the limit is not maintained by the end of SR 2078, the banks or financial institution must make a 100% loan loss provision for that loan. Banks and financial institutions must prepare the details of personal loans with unspecified purpose in the format as per Nepal Rashtra Bank Directive number 2.4 and submit it to the relevant supervisory department of this bank within 15 days after the end of each quarter. Number 26. Regarding the debtor having obtained a permanent account number PAN. Banks and financial institutions must ensure that any individual receiving a loan up to loan of Nepali rupees 2.5 million or more, whether as a single amount or cumulatively, must have a permanent account number PAN. Additionally, according to Directive number 3.7 of the Directive, if the borrower falls under the same group, then even in cases where an individual within that group needs to be provided with a loan of less than Nepalese rupees 2.5 million after having taken a loan of Nepalese rupees 2.5 million or more, it is mandatory for them to have a permanent account number. Number 27, regarding the loans provided to risk taker, that is director, chief executive officer, CEO, or management level official. A licensed institution cannot extend any form of loan in the personal name of directors, CEO, or high level management officer of another licensed institution except for educational loans, hire purchase loans, home loans, or loans for household purpose. However, this provision is not considered an obstacle for obtaining loans against government bonds, fixed deposits, or gold and silver collateral. A licensed institution cannot extend any type of credit to a firm, company, or institution that is mostly owned by the executive head or a management level official of any licensed institution. For this purpose, mostly owned refers to a firm, company, or institution with more than 50% ownership. With regard to loans taken before becoming a director, executive head, or management level official, the loan must be regularized within the repayment term or within 1 year, whichever comes first. Number 28, regarding the disbursement of loan amounts via account pay checks. When disbursing the approved loan amount to any company or firm or organized association or institution, it must be deposited by opening an account in the concerned bank or finance institution. In other circumstances, the loan amount should be disbursed to the debtor company or firm or organized association or institution's account through an account pay, check, letter, or electronic means, ensuring it is deposited in the respective debtor's account. 29, regarding the disbursement of loans only after analyzing environmental and social risks. Before licensed institutions invest in loans for project or industries requiring establishment, permission, approval, or consent, the loan investment should be based on the approval of the Initial Environmental Examination (IEE) and Environmental Impact Assessment (EIA) report from the concerned authority. For projects or industries that do not require IE or EIA, the licensed institution must conduct an environmental impact analysis themselves before proceeding with loan disbursement. In this regard, the licensed institution must formulate necessary policies and conduct credit evaluation by analyzing environmental and social risks as mentioned in the guidance while complying with the provisions in the Environmental Protection Act 2019, Environment Protection Regulation 2020, Labor Act 2017 and other prevailing laws, as well as the Guideline on Environmental and Social Risks Management ESRM for Banks and Financial Institutions 2022, issued by the bank, and implement monitoring and reporting accordingly. The report according to the Schedule 11 of the Guideline on Environmental and Social Risks Management ESRM for Banks and Financial Institutions 2022 must be submitted to the relevant supervisory department within 30 days of the end of the fiscal year payments. Number 30, regarding the payment schedule for agricultural loans. When constructing the repayment schedule for the collection of agricultural loan installments, it should be designed in a way that aligns as closely as possible with the harvest time when farmers collect their crops and the timing for loan installment payments. Number 31, responsible only up to the amount stated in the guarantee document. So when giving a guarantee, it must be clearly stated that the guarantor, person, firm, a company or institution cannot be held responsible for an amount exceeding that mentioned in the guarantee amount or guarantee document. The guarantee document must clearly specify the guarantee amount, loan duration, purpose of the loan, principal debtor, witnesses, name and address of the guarantor, and identification among other subjects. Number 32, arrangement regarding concessional loans. Nepal Ashta Bank will provide the grant amount given by the Government of Nepal for loans disbursed according to the Integrated Working Procedure for Interest Subsidy on Concessional Loans 2075. For the purpose of calculating the capital fund ratio, the amount to be received as interest subsidy from the Government of Nepal for loans disbursed as per this procedure can be assigned a 0% risk weight akin to claims from the government. Banks and finance institutions are required to publicly disclose the details of borrowers who have received concessional loans on their website on a quarterly basis. Number 33, tax clearance or submission certificate. Banks and finance institutions will not be required to obtain the latest tax clearance certificate or updated tax clearance or submission certificate from the borrower when providing or renewing loans up to Rs 5 million to firms or companies. Loans or renewals for agricultural, tourism and small to medium sized industries, professions or businesses exceeding Rs 5 million up to 20 million can be granted based on tax filing documents. For any other firm or company not covered under subclause A or B and seeking or holding a loan exceeding Rs 20 million, the loan can only be granted or renewed after obtaining the latest tax clearance certificate from the borrower. So, when approving or renewing a loan for any firm or company, the financial information available in the integrated tax system of the Internal Revenue Department for the relevant firm or company must also be considered as a basis. Additionally, arrangements must be made to enter the approved loan amount and date into that system. Banks and financial institutions can obtain the necessary username, password, and additional information required for access to this system from the tax office where they are registered. Next is number 34, that is credit rating. Licensed institution must consider the rating by the credit agency or credit rating agency of the following institution as a basis for credit evaluation when disbursing and renewing loans as stated below. Very first point is borrowers utilizing loans of 500 million rupees or more. However, this provision will not be mandatory for loans disbursed to D-class microfinance finance institutions. For construction businesses, borrowers utilizing fund-based credit of 500 million rupees or more or non-fund-based credit of 1 billion rupees or more. Provision number 35, regarding the release of collateral. The banks and finance institution must send a written notice to the concerned office for the release of the collateral used as security within 5 working days after recovering the entire amount owed from the loan investment made. Next is provision number 36, arrangements regarding working capital nature loans. Banks and financial institutions are required to process, renew or review loans of a working capital nature from Kartik 1st, 2079 in accordance with the Working Capital Loan Guidelines 2079 issued by this bank. Working capital nature loans provided before the implementation of the Working Capital Loan Guidelines 2079 can only be renewed in full compliance with the guidelines. If a renewal is found not complying with the guidelines, 100% loan loss provision must be maintained on that loan. However, the provision regarding variance in Section 7 of the Working Capital Loan Guidelines 2079 will only be implemented from 7/1/2082. Similarly, short-term and working capital nature loans classified as pass on the last day of the month of Chaitra 2079 with regular interest payment may have their tenure extended by 3 months without any penalty or fee based on necessity and justification by the end of Ashar 2080. Number 37. Loans of Nepalese rupees 2 billion or more that are being utilized by borrowers through multi-banking arrangements must be converted into consortium loans. Multi-banking loans that are not converted into consortium loans according to this provision should be classified under the watchlist category, and an appropriate loan loss provision must be maintained accordingly. However, it will not be mandatory to convert loans provided to microfinance finance institutions under deprived sector loans into consortium loans as per this provision. Similarly, for licensed institutions that provide hire purchase loans, if bank and finance institution take fixed assets like vehicle and machinery as collateral and provide loans up to 50% of the purchase price, ensuring the full value of the asset is insured, consortium financing will not be necessary. Number 38. When accounting for interest income, banks and finance institutions must comply with the expected credit loss related guidelines 2024 issued by this bank. Number 39. To encourage income generating activities in areas affected by earthquakes as well as in commercial agriculture, animal husbandry, and small to medium sized businesses, banks and finance institutions can accept cultivable land even without motorable roads as collateral for loans up to maximum of Nepalese rupees 2 million based on borrower's repayment capacity. Licensed institutions must set the debt interest rate by adding up to only 2% over the base rate when extending loans of up to NPR 20 million for businesses related to food production, livestock, poultry, fisheries, supporting industries for agriculture, agricultural tool production, export-oriented industries, handicrafts and skill-based enterprises, information technology, tourism and enterprises related to domestic production, as long as they are based on 100% domestic raw materials, in excluding import-related businesses. And when extending loans as per this clause A up to NPR 2 million, banks and finance institutions can accept arable land without motor roads as collateral. Each branch must approve such a loan application within 7 working days of receipt, and if approval is not possible, they must provide a clear explanation in writing to the concerned customer. Loans disbursed to projects that have started exporting electricity after constructing electricity projects should be provided at a rate not exceeding 1 percentage point above the base rate for up to 5 years from the start of exports and for the entire loan period in the case of reservoir based hydropower projects. Loans should be provided at the base rate if requested for the purpose of establishing a liquid oxygen plant or an oxygen plant by currently operating healthcare service providers, hospitals or industries. For loans requested to establish industries recognized by the Government of Nepal for the production of vaccines or biologicals for the treatment of pandemic related disease, banks and financial institutions should evaluate the business plan and provide loans as the base rate. In local levels without hospitals, banks and financial institutions can provide loans up to NPR 200 million by adding a maximum premium of 2 percentage points to the base rate for establishing hospitals with up to 100 beds. For the production of fruits and herbs and or projects aimed at processing entirely domestically produced fruits and herbs, banks and finance institutions must disperse term loan with a premium of no more than 2 percentage points added to the base rate. This interest rate will not apply to loans dispersed for land purchases. When extending loans to the private sector for the construction of information technology parks and industrial parks, the interest rate must be determined by adding a premium of up to 2 percentage points to the base rate. For the construction of residential homes damaged by the earthquake in Kartik 2080, the interest rate on housing loans up to NPR 2.5 million provided to families listed as earthquake affected by the Nepal government or bodies designated by the government must include a premium of up to 2 percentage points added to the base rate. Number 40. For agricultural production, businesses like coffee, oranges, tea, and for livestock and dairy production businesses, loans of up to NPR 50 million can be disbursed based on feasibility with the project itself serving as collateral. If there are any complaints regarding this, the concerned customer can lodge a complaint with this bank clearly stating the details. Number 41, regarding loan recovery proceeding. Before initiating public notification and collateral auction proceeding for the recovery of a loan extended for more than 1 year, at least 6 months must have passed since the loan became overdue and classified as doubtful. When publishing a public notice for loan recovery, it is not permitted to publish images of natural person. 42. Arrangement for recovery of principal and interest on loans. When collecting amount from borrowers, licensed institutions must prioritize collecting the entire interest amount first, and then the remaining amount should be adjusted towards the principal. In the case of loans with installment payments, there will be no obstacle to recovering the oldest pending installment first. However, this provision will not be mandatory for restructured and rescheduled bad loans that are in the process of being recovered through the sale of collateral. Regarding interest capitalization, interest that matures during the grace or moratorium period of a project loan shall not be capitalized. However, in priority sectors specified below, based on necessity and justification, interest capitalization will not be considered as an impediment. Industries related to hydropower production, transmission, or distribution. Industries related to the production of clinker and cement using domestic raw materials. Pharmaceutical industry, cable car industry. Industries related to sugar production, dairy product manufacturing industry. Medical colleges that have received letters of intent from the relevant bodies of the government of Nepal, tourist standard starred hotels, hospitals, long-term agricultural projects such as involving fruits, spices and herbs, and pulp and paper industries using domestic raw materials. Interest on restructured or rescheduled loans cannot be capitalized. So, even after the completion of the hydropower project and the commencement of production, projects that cannot operate at full capacity due to lack of transmission line construction may partially capitalize the interest amount to the extent that the net sales revenue does not cover it until the transmission line is constructed and operational. The board of directors of the concerned banks or financial institution must decide to capitalize the interest in this manner. When capitalizing the interest during the grace period, the capitalized interest amount must be accounted for separately under the title of Interest Capitalized Term Loan (ICTL). The repayment period of the ICTL can be determined by the concerned bank or financial institution based on the project's cash flow analysis. Number 44. If the borrower pays the principal or interest obligation of the loan within 30 days after its due date, penalty interest cannot be charged. This provision will only apply to the principal or interest which is due by the end of May 2023. However, if any borrower fails to pay the principal or interest during the grace period, this provision will not be considered as an obstacle to charging penalty interest for the entire overdue period as per the predetermined conditions. Number 45. Banks and financial institutions will need to extend the repayment period for principal and interest on loans related to the construction industry that have encountered difficulties due to circumstances until the end of March 2081. The interest on such loans cannot be capitalized and penalties, fees, fines or interest on interest will not be permitted. However, if the principal or interest of the loan is not paid within the concession period, this provision will not be considered as an impediment to the charging the penalty interest for the entire overdue period according to the predetermined terms. Number 46, regarding the maintenance of the debt service to income ratio. Banks and finance institutions must adhere to the following limits. For installment based non business loans such as personal installment loans and hire purchase loans, as well as for personal overdraft loans, the maximum debt service to income ratio should be 50%. For loans disbursed for the purpose of purchasing or building real estate, the maximum debt service to income ratio DTI should be 70%. Verified documents revealing the debtor's income source must be included. In the case of income subject to tax from the income submitted by the debtor according to clause A, the gross income of the debtor will need to be calculated on the basis of the tax clearance or certificate of updated tax clearance that has been settled or paid. Additionally, tax clearance certificates related to income must be obtained annually during the loan period to update the debt service to income ratio of the debtor. If a licensed institution disburses a loan exceeding the maximum limit, such loan must be classified under the watch list for close monitoring. 48. Regarding the submission of credit classification details, licensed institution must classify credit at the end of the financial years Ashwin, Push, Chaitra and Asad and submit the details according to the attached directive number 2.1, 2.2 and 2.3 to this bank within 7 days after the end of each quarter. Regarding the submission of collateral details during loan recovery, banks and financial institutions must submit details to the relevant supervision department quarterly in the format specified in directive form number 2.7. Now last one, cancellation and preservation. The following directives previously issued by this bank have been cancelled. The directive issued under the provision relating to credit flow, classification and credit loss in Integrated Directive 2080, Tech number 2, and all circulars related to the same subject issued up to the end of Push 2081. Actions carried out under the directives and circulars cancelled as per subpoint 1 shall be considered as carried out under this directive.